You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
We are not proponents of the supercycle thesis. Due to the analysis we've carried out previously over the last couple of years, principally, you won't know there was a supercycle until after it's over.
Welcome back to Mining Stock Education. I'm your host, Bill Powers, and in today's episode, we're going to be getting a commodity outlook for 2023 from Alex Christopher. He is a multi-commodity analyst with the CRU Group. Alex, welcome onto the show for the first time. Perhaps give a little more information about yourself and your company, the CRU Group, please.
Thank you very much, Bill. Thank you for inviting me to talk today and share my thoughts with the Mining Stock Education listeners. It is an absolute pleasure to be here and at the start of what could be a very, very interesting year. I'll start with the introduction of myself. So I am Alex Christopher, a multi-commodity analyst here at CRU Group in London, England. I'm a former exploration geologist of around 3 years experience. Not a long amount of time, but a lot happened in that time. In that role, I worked for a private equity group with global interests. During my time, I had the opportunity to research and physically explore in 7 countries, including Norway, the US, Montenegro, and the Republic of Ireland, focusing on base, precious, and battery metal exploration. As you can imagine, it was a whirlwind experience in a short period of time, as I say. I then made the move and jumped behind the desk, so to speak, in mid-2021 to join the CRU Group in my current role in the analysis division. Primarily, I conduct cross-commodity analysis, keeping things high level as a part of a central team which is tasked with this. And I also hold day-to-day responsibility for content delivery to our exclusive partner in the credit rating agency, Fitch Ratings. CRU Group itself, I should mention to those who don't know us, we are a business intelligence company focused on the mining, metal, and fertiliser space. We're around 360 people worldwide in all the classic mining destinations. We're independent. We don't hold positions, so our views aren't coloured by certain positions that people may want to take. We cover everything from the steel price tomorrow. There are steel price benchmarks that we have at CRU Group. Prices, market fundamentals over the medium term and long term. And in addition, we host international conferences in the metal, steel, and fertilizer space, including the World Aluminium Conference, for example, coming up in May. And finally, we have a new sustainability division, which aims to answer the big questions on sustainability as this topic becomes ever more important on the international stage, and particularly, of course, in the mining, metal, and fertilizers space.
Thank you for that background, Alex. Let's jump in with our first question. Goldman Sachs, they are seeing a supply-driven commodity super cycle, and they expect commodities to be the best performing asset class this year. Would the CRU Group hold a similar view?
So, great question. Here at CRU, we are not proponents of the supercycle thesis. Due to the analysis we've carried out previously over the last couple of years, principally, you won't know there was a supercycle until after it's over. So if we dig into this a little bit, commodity price movements can be divided into a number of distinct phases, one of which, of course, is a super cycle, the others being long-run pricing trends and business cycles. What exactly is super cycle? What underpins this? So we see this as longer-term price increases, which affect a very broad range of commodities. Note this doesn't have to be direct on all commodities, but it often reverberates, where it isn't direct. Typically lasting 20 years or more, and are caused by years of low investment, insufficient capacity, and historically low prices. Further to that, in the shift in environmental political factors, holding back effective supply and large and persistent step up in demand, further support super cycles. Now, example of this kind of step up or demand pull, which I referred to there, this was last clear in the last evident super cycle through the 1990s to 2000s, driven by the structural demand shift created by the modernization of China. Now, what we are seeing now are shorter term, in our opinion, are shorter term price increases or business cycles. These are caused by the temporary shortage in stocks and supply disruptions, and sudden bursts and potential sudden demand bursts in demand, which we've seen, from the pandemic and the war in Ukraine. Now, right now there are some supportive factors of a super cycle at present across some markets, and increasing weight on these because of the shocks I mentioned. But for example, if we take this demand pull part of it, which is very important, there is no doubt, for example, that energy transition is a common source of notable demand for a number of commodities. But this needs to be balanced against other factors, which could be commodity specific. So, if we take copper, for example, will supply meet demand in the medium term? Will there be substitution effects, demand destruction with high prices, the effects or increase of recycling? And if we do look at copper, to take one example to kind of round off this point, if we look at supply in the medium term, we do not expect a supply gap to open up. So we do expect a supply gap to open up at the end of the forecast period, being around 2027, following a period of surplus beforehand. The move to a deficit at the end of this forecast period is a precursor to and a reminder of a potentially wider, long-term supply gap that exists within the copper industry. Consequently, we forecast the price trending up towards $10,000 per ton. I think people throw that figure around all the time in the forecast period. This view is underpinned by our own Project Gateway methodology, in which we use to assess the number and volume of copper and the supply gap and how big it is, etc. We take into account changes in recycling rates, the scrap market dynamics, and from things like building life cycles. So those that forecast very high prices in this sector, for example, may not take such factors into account. And our view of an upward trend toward $10,000 per ton in the medium term is not necessarily supported in the long term, which then puts into question a decisive super cycle outlook, particularly when you do think of a substitution of copper, for example, by aluminium in the renewable sectors. So to kind of sum up, we can't say there's any conclusive evidence that the super cycle is beginning or happening now, but there are certainly some supportive elements out there.
Elon Musk tweeted yesterday, and this really kind of caught me off guard. He said, no change in copper production is required for the transition to sustainable energy. Would CRU's position agree with that based on what you just say?
So our view is that we expect, from the electric vehicles boom, which I'm sure we'll get to again later, that the requirement for copper, so the demand for copper will quadruple by 2030. Now, in the project pipeline, so we have some of these factors kind of factored in. In the project pipeline, there does exist at this time enough supply in the long term to fill the gap. But what we should say, and I make this point, very, very clearly, is that the projects in the project pipeline are often much smaller than smaller projects. They're not the huge, tier one projects because there is a reluctance among major companies to commit the capital expenditure required. So I would say yes, there is enough in the pipeline. Obviously, how that pans out in practice depends on a few factors, including, obviously, as I'm sure you're aware, the situation we now see in South America with a lot of the kind of protests and obviously issues around water scarcity.
So your group advises firms and individuals on where you see the commodity prices going. When you look back on your calls and forecasts of last year, what did you get most accurate and inaccurate? And if you could break down that assessment for us, please.
Yeah, sure. So first thing to say, so at CRU, we often represent our price forecasts on a cross-commodity heat chart. So this includes 38 key commodities across the metals, precious metals, fertiliser and raw materials sectors. This basically shows year-on-year price gains for commodity groupings. Overall, and places individual commodities in temperature ranges. So the kind of hot would be above 15%, and freezing would be below minus 15%, and at 5% intervals in between. So in late 2021 to early 2022, I remember writing an insight at that point as well. I can speak to this quite well. So the CRU commodity basket showed that we expected prices overall to edge higher by just under around 10%, with some big rises, particularly the fertilizers, and some big decliners, namely being steel. Now, by and large, in 2022, this did occur, but the kind of magnitude and scale did differ. Now, this is obviously due to the supply shock created by the implications of the Russian invasion of Ukraine. This was particularly felt in markets where Russia, Ukraine, and Belarus, for that matter, were key global and regional suppliers such as oil, natural gas, nickel, steel, and fertilizers. So looking at steel, just for an example, so North American HRC, which is hot rolled coil steel, and we're expecting a drop year on year in freezing category, so a drop of over 15%. In the end, because of the spike caused by the war in Ukraine, we saw over the spring and the summer, this has ended up somewhere around 10%, so a bit less, because obviously the kind of the price elevation that occurred there was obviously quite stark. Another example of the effects of war would be in the nickel sector. We have this as a mild winner, so around 5 to 10%. But because of the uncertainty that dogged the market, because Russia is a huge, obviously, producer of nickel, this kind of uncertainty that lasted for quite a long time until later on in the year, until the LME, for example, confirmed that they weren't going to ban Russian-sourced nickel. So in the end, nickel ended up being a much bigger winner than we expected earlier in the year. So overall, I think we've been pretty accurate, economic black swans aside, which I think is a testament to the global reach of the CRU Group.
What about for 2023? What's your most bullish or your hottest commodity that you forecast? Yeah, using your language.
So when talking about the hottest commodity, the best performing commodities, we can talk about simple year-on-year annual average changes, like I talked about there. To that end, 2023 does not look like a great year for commodities at all. With the commodity basket as a whole expected to decline just under 20%, with all groupings in that seeing declines, fertilizers taking the biggest hit. There are currently some individual gainers. So lithium on a contract price basis, I should stress, that's looking up. Molybdenum and platinum amongst a small handful of others. On gold, which obviously people are typically quite interested in, we are cautiously bullish. Prices should inch higher as the dollar weakens with a more hawkish Federal Reserve. Any hint of rising hawkishness, which is possible, obviously would put downward pressure on the metal. Hence this cautiously bullish tone that we're taking. However, I would say, is a simple year-on-year assessment the best way to look at things? There are lots of reasons why a simple year-on-year average price change is not enough to call it the best performing commodity. Context is, of course, needed. One, prices are coming down as a part of a normal price cycle. They are coming down from, in some cases, quite exceptional highs, particularly in the case of steel. A key thing also, and I can't stress this enough, is margins. Price is only relevant in the context of cost. It's the margin between cost and price that really matters. An example of this would be that if we take iron ore. So iron ore, trading at $120 per dry metric ton, which was the average 2022 price. A significant proportion of production is profitable with the price at that level. First quartile producers, we're making exceptional profits, with their kind of cost looking at around, $40, $50 per dry metric ton. However, moving into this year now, and the back end of last year, in fairness, margins are now being squeezed. Last year, low-cost producers in the iron ore sector saw their costs rise more than higher cost producers due to higher exposure to things like the oil price, as well as a proportionally high increase in labor costs and freight. If we look at, for example, the base metals, margins again high last year. If we zero in on copper, while margins were high, there was also a decline in those margins as inflation, hit input costs, particularly labor, and obviously this still persists. That being said, we expect copper to be somewhere around the $8,000 per ton price range this year. At that price, a overwhelming majority of copper producers on an all-in sustaining cash cost basis are profitable. That's something to think about there. And a kind of final example of this kind of margins point, steel. So by contrast, steel has now come through the other side of what was a once in a generation price story, characterized by huge spikes in margins, and that price is now falling to kind of normal levels.
And if you could pinpoint the coldest or most bearish commodity for this year, could you elaborate on that too, please, Alex?
Yes, for sure, Bill. So if we look at kind of the groupings, so I think as a group, fertilizers, I think I mentioned before, so we expect kind of nitrogen prices in the fertilizer industry to decouple from costs, which are expected to obviously increase again in 2023. We expect the prices to decouple as there is ample supply of nitrogen products around. Now, principally, the Russian invasion of Ukraine again curtailed Russian and Belarusian supply. Let's not forget Belarus is a huge producer of nitrogen products. And the supply of fertilizers and key raw materials such as potash, high-grade phosphate, and natural gas, obviously, that was also curtailed too. This supply reduction and subsequent raw materials price hike from other producers has raised the cost of fertilizer production in 2022, resulting in historically high price levels. These price levels have, however, proved untenable to most consumers. So we've seen demand destruction in the late half of last year, and we expect this to continue in the sector into 2023. Now, if we look at some bearish factors to consider elsewhere, energy plays an important part, of course, in the metal industry. As is the case in increasing cost in the fat space, energy-intensive metals also need to watch out this year. The story here comes with some nuance, however, due to some regional factors. So, for example, zinc smelting in Europe is at significant risk because of the acute energy problem we have here in Europe, whereas energy poses less of a risk to copper smelting, for example, in South America, which obviously, however, does face some risks of its own.
So, Alex, when we look at the North American versus the European natural gas markets, what's the possible effect on energy intensity and gas-intensive commodities?
So I think the key point is European energy and gas-intensive industries are almost by definition at this point more at risk. So the US has obviously seen large price increases, although in some areas it's come down now, but they are nowhere near the scale of the European levels of cost. So the EU has done very well in diversifying away from Russian dependence with big and rapid investment in LNG capacity, and also at reducing demand to ease supply fears. However, it's worth noting that while pipeline gas imports are now close to nil, LNG imports from Russia did hit a record high in the EU in 2022, and the Russian nation itself will be increasing capacity in 2023. So while the EU has other agreements in place for LNG imports from elsewhere, the global market remains very tight. The bloc has overcome the challenge this winter, but next winter remains uncertain. Some capacity restarts have been scheduled in some industries, zinc and the fat sector, but things, of course, remain on edge. And we believe restocking for winter 2023-2024 will be very difficult. And just to kind of illustrate the kind of contrast between North America and Europe, for example, if we take steel, US mills are actually more energy intensive overall, but it's European mills that are more at risk due to the supply risk that I pointed out.
Okay. And CRU's overall market perspective across the broad commodities complex for 2023, any more you can share here?
Yeah. To mention the war in Ukraine again there. So
Yep.
in 2022, obviously most commodity prices have now declined from their peaks, resulting from that supply shock, amid concerns, obviously, of an impending global recession. Now, looking ahead, this downward trend, obviously, we do expect to continue into this year. From a price perspective, except for energy commodities, so natural gas, for example, being one, for which there does remain a upside risk, despite, I have to say, recent better than expected news, which people may be aware of in the last week coming out of Davos. We expect inflation to continue to fall, but it should be noted that it will still remain high. General sentiment is improving, albeit again from very low levels due to the demand uncertainty, particularly regarding China. So referring back to the CRU kind of commodity basket again, as I said, we currently expect that to decline just under 20% year on year. But with the swift and successful opening of the Chinese economy, this would have a material effect on this. We believe Q1 is likely to be quite choppy, particularly obviously with Chinese New Year that just passed this weekend, and several other holidays, which obviously may lead to renewed spikes in the coronavirus, which obviously will have implications for both economic activity, production, and supply. We do expect things to start to recover there sometime in Q2. But I think the key thing here is it should be noted that at this time, the fundamentals are weak across the board in regards to that. However, there has been some encouraging, I would say, news regarding iron ore today about the fact that it seems like actual demand is starting to pick up, but that's very early to say that. But just looking just a little bit more deeply, so I want to return to margins again, very important. So they will continue to be squeezed in 2023, particularly in Europe, as continued curtailments in fertilizers, energy-intensive metal sectors, etc. What is noteworthy is that producers enter this economic downturn, generally speaking, this is in a better position than previous cycles, and are generally better placed to weather it, we believe. This is primarily because they're less highly leveraged. Prices are coming down also, as I said, but from high levels. And for the most part, despite this, margins will remain robust. There's a strong demand story, as I said, for materials exposed to the energy transition and the opening up of China, but not so great as to pull costs significantly up.
So for all the mining listeners, such as myself, hearing this analysis, can you tip us off as to CRU Group's, the key global trends that we should be aware of as mining investors for the coming year, please?
For the coming year, yeah, sure. So I think, two things here. I mean, I can talk to the kind of natural gas situation, but I can first talk to key trends that I keep an eye on. So one thing I like to keep an eye on is, resource nationalism. So this is something that is always a factor, of course, in the extractive sector. But it particularly comes to the forefront when prices, margins, and costs are high. As a former geologist, I like to say this: geology, of course, dictates where resources are found, and nations rich in natural resources typically, in such times, would like to retain as much value as possible in country instead of profits being lost further down the value chain, and also, it was a case, obviously, to boost investment in country as well. Now, this is what we've seen, for example, last year with Indonesia, with talk and some action on different bans, be it talk of a nickel ban, the thermal coal ban, etc. And this is all done, obviously, in efforts to force more capital investment in the case of nickel, for example, for nickel in-country nickel smelting, which obviously is more lucrative than export than the raw material end of things. And also, they've now brought forward talk about a bauxite ban as well for a similar reason. In addition to this, we should keep an eye on there was a global increase in critical minerals policies, which some may consider protectionist, albeit for a good reason. This practice of resource nationalism and possibly protectionism also permeates into the energy sector, which again is important, obviously, to the metal sector. But the importance of this is increasing for energy security and stability as countries are starting to accelerate investment and installations of renewables capacity, which has a clear upside risk for metal demand. A headline to kind of share on this kind of renewable front is that we expect renewables, and by that I mean wind and solar voltaics, to overtake thermal coal power generation before 2030. I think the other key thing that I would say that people need to keep in the back of their minds is the other side of the green energy transition, so namely electric vehicles. So EV sales have so far, at the back end of last year into this year, have resisted the bleak economic outlook. China, of course, continues to drive substantial growth in the NEV market. Chinese 2022 sales grew over 90% year on year and account for around 60% of sales globally. In Western Europe, the market has fared worse due to supply constraints and rampant energy costs that I've referred to, which obviously dampen consumer confidence. And in North America, more relevant to your listeners, North America fared much better, and we expect sales to roughly double in 2023. So I think overall, over the medium-term forecast, we forecast electric vehicles will move beyond the early adoption phase to the early majority phase.
Excellent. Alex, if listeners want to get in touch with you, what's the best way to do that?
The best way to do that would be to contact me by email. So my email is alex.christopher@CRUGroup.com. Please, anyone, feel free to reach out about anything I've talked about today or anything else. And I'm happy to help, or certainly direct you to a metal-specific analyst that may be able to help you further.
Excellent. Thank you for coming on the show today, Alex.
Thank you very much. Much appreciated, and thank you for having me.